All right, let's start talking about the balance sheet and the financial statements themselves. The first, well, really, we should be starting to discuss these things in income statement order since that's the way they should be prepared, but we'll go with the way the slides are laid out. Let's start off talking about the balance sheet and the items that are on the balance sheet. The balance sheet is called a classified balance sheet because it's broken up into different categories. Really, it's broken up almost into short-term assets and long-term assets. When you think of short-term assets, the term that's also used is called current assets. The idea there is that these are assets that are going to be typically used up within a year or less, or during a normal operating cycle. And what I mean by a year or less is that these assets will be used up or converted to cash within a year. Some examples of those current assets would be like cash is a current asset or a short-term asset. Accounts receivable. Accounts receivable, if you think about accounts receivable, that is the money that's due to you. Presumably you want that money paid to you within less than a year, so that's also going to be classified as a short-term asset. Again, supplies, really anything that you're going to use up within a year. It's really about the time frame is going to be listed as a short-term or a current asset. Another item that you typically see in here is prepaids. Any sort of prepaid expense. Prepaid insurance, prepaid I can't think of another prepaid. Prepaid insurance, supplies, like is on here. Any of those things are used up typically, are listed as short-term assets, even though they could at times cover more than a year. So if you had an insurance policy that you prepaid in advance and it was good for 2 years, I realize that goes beyond the within a year or less of the category. But just as a matter of practice, prepaids tend to be all listed as a short-term asset. Okay, so if you see a prepaid, think of it as short-term. Notes receivable actually can go either way. It can be listed as a short-term asset or a long-term asset. It's all about the timing on a note. A notes receivable, if it's due in less than a year, gets listed as a short-term asset, and if it's due in a year or more, then it's going to be listed as a long-term asset. So it's really about the timing as to how a notes receivable is classified on the balance sheet. A little bit of something I want to talk about with accounts receivable versus notes receivable. Now, accounts receivable arises from your regular business, doing whatever it is that you do. If you're, making donuts and you're selling them to local supermarkets, well, that's going to be in an account receivable because you're selling donuts and you're waiting to get paid. That's an account receivable. A note receivable is usually a more formal document, and it's not something that usually arises from your regular business. So a note receivable might be somebody owes you maybe you loan somebody some money and they owe you the money. Well, now it's going to be a little bit more formal, right? There's probably going to be something written down, some sort of agreement. There's going to be a payback period. There's going to be usually an interest rate associated with it. Okay, so overall, a note receivable just tends to be a little bit more formal, whereas accounts receivable is just something that just happens as part of your regular business. Somebody owes you money doing whatever you do in your business. Okay, so it's the difference between accounts receivables and note receivables. Okay, so let's talk about long-term assets. Long-term assets could also be called fixed assets. They could also be called property, plant, and equipment. Okay, the idea here is you've got a bunch of names, but all for the same basic items rather. Really, these are things that are going to last you for longer than a year. So if you look at the items that they've got listed in here, equipment, machinery, buildings, land, if you had autos, anything that really is longer than a year that you're going to hold on to is going to be called a long-term asset, or, as I said, property, plant, and equipment. You'll see PP&E sometimes. You'll see fixed assets. All of these things are items that are going to last for longer than a year. And just a little side note here, all of these items are subject to depreciation except for land. Land is never, ever, ever, ever depreciated. Just had to get that ever in there. Okay, after you've got on the balance sheet, after you're done with your assets, you've just broken down to short-term and long-term. Now you can look at your liabilities, and guess what? They have the same breakdown. Liabilities can be listed as short-term or long-term. It's all about the payback period. If the money or the whatever is due to somebody is due within a year or less, then it's going to be a short-term or current liability. And if it's longer than a year, then it's going to be listed as a long-term liability. Okay, so the reasoning is very simple to get your head around. All right, so let's just talk about some of the examples that are in here as short-term liabilities. So you've got accounts payable. Well, presumably people want to get paid within a year, right? If you owe the utilities company money, they're going to want to get paid within a year. If you pay your, well, let's say accounts payable. So let's go back to, say, we have a donut business, right? I like using donuts as my example. Let's say we have that donut business again. The people who I'm going to owe money to in my main business, which is where an accounts payable is going to arise from, are going to be like my sugar supplier and my flour supplier and my oil supplier and the people who give me sprinkles, right? Those are going to be the people to whom I owe money making my donuts. So that's going to be listed as an accounts payable. And like I said, those people expect to get paid probably within a year. So that's going to be listed as a short-term or current liability. Wages payable. I'm sure your employees want to get paid in less than a year. Interest payable. Any sort of payable that you would expect to get paid in a short-term fashion is going to be listed here. Unearned fees. You remember unearned revenue and unearned fees and all that stuff from Chapter 3? Well, that's usually when you're paid in advance of doing a service, right? Well, if somebody pays you in advance and you have this unearned revenue in your books, okay, so you got, let's say, $1,000 for lawn cutting services, and somebody gave you the money and expects you to cut their lawn for the next 4 months. Well, the case is going to be that they're going to expect you to provide your service to offset those unearned revenues. They're going to expect you to provide that service within a year probably. So any sort of unearned revenue that's, expected to be, where the service is expected to be completed in less than a year, is going to fall into this short-term category as well. Long-term liabilities. All right, so anything long-term, anything that's going to be longer than a year. A note payable. Now the notes payable, again, can go both ways here. They have it listed under long-term liabilities, but really it could go either way. If it's a notes payable due in 6 months, it's going to be a short-term liability. If it's a notes payable due in 16 months, then it's going to be long-term. A mortgage payable, bond payable. We'll talk about bonds more in the future, but bonds are basically a way for a company to raise money. They could raise, there's a couple of ways a business could raise money. They could sell their own stock. They could sell out a bond, which basically says, we're going to pay you interest maybe for 10 years, and at the end of 10 years, I'll pay you back the amount of money you loan me. That's a bond payable, basically. So if you have a bond payable, presumably it's for a long-term period, 5 years, 10 years, 20 years. And so those are traditionally going to fall into long-term liability. And then you've got your third section, which is stockholders' equity, and it's the rights of the business from the owner's perspective. Okay, so you're going to have things in here like capital stock. If the owner has, the capital stock that the shareholders have bought. All right, if you think way back to your journal entries in Chapter 2, when somebody put money into the business, typically they got capital stock. Well, that's going to be listed here. Additionally, what also comes in here is retained earnings, right? That comes over from the statement of retained earnings, and the final balance of retained earnings comes over to the stockholders' equity section. And again, of course, your assets, at the end of all of this balance sheet, your assets must equal your liabilities plus owner's equity. That is the rule in which you live by. As we've discussed before, the income statement is just going to have revenues minus expenses, gives you, and gains and losses, gives you, sorry if you guys hear my 6-year-old in the background here, your revenues minus your expenses gives you net income, right? And hopefully your revenues are more than your expenses, so you have income. Rather, if your expenses are more than your revenues, then you're going to wind up with a loss. We're going to get into talking about the balance sheet in a lot more detail in the income statement in a lot more detail in the following chapter, Chapter 5. For now, I think I'm going to cut off, and we'll continue with the third section, which is after we prepare the financial statements, we're going to be working on what's called closing entries.